Hey everybody, good morning, good morning, good morning. We are doing a little impromptu, well, I don't know if this is the Red Sea or what the hell this is, but we got some, basically we got some interesting stuff going on, and I'm just adding, there's Mr. Phil Newton Esquire as well, and dude, yeah, absolutely, we got some, to say that it's an interesting day would be, there we go. We can put us. I'm hitting the right buttons now in the right order, and Phil is half on the screen, half off. But there you go. Shit happens.
Well, I can't tell where you're at, Sean. It's not my fault.
It's bloody hard sometimes with this stuff. But
I'm dead center of my camera. I don't know what you're looking at.
I'm looking at a sea of red and panic in the streets. Oh my god! Oh my god! Pants are on fire along with cats and dogs living together, all in perfect freaking harmony. But we were talking just before, well, like an hour ago. I'm walking my dog, and Phil goes, "Have you looked at the markets?" And I went, "Nah, not yet. I haven't sat down. Just now sat down with my cup of coffee." I have to highlight the copy. There you go, because it's all about personal development. Yeah, namaste, bitches. But what we're going to be doing, guys, is just look at the sea of red. And now one thing I'm going to highlight here, because we're also doing this as an impromptu podcast, as well as a broadcast. Now it became a podcast, but making words up as we go along. But as you can detect, there's no panic in our voices. There's no worry. We're like, I'm not even... Yeah, even though Phil says, "Hey, have you looked at the markets this morning? We should probably do something about this and say something." And I'm like, yeah, okay, what's going on? Because it's awareness is there, but it's not a worry about when things happen like this. So do you want to do a quick summary of what we're looking at? And I'm going to pull up a couple of, I'll just pull up, kind of like a little summary of the markets. Now, the first thing that made me giggle was, well, I say giggle. It's not, that sounds bad. But one of the things is we were talking about the VIX and the indication that something might be coming. And sure enough, I actually put a little tickle on the VXX, which is the ETF. Indeed, Phil has his own acronym, so to speak, for a good tickle. But yeah, we've got a pop in volatility, not surprising given today. So let's do a quick summary of what we're looking at and what the situation is, and we can go into a why and what is actually going on.
Well, for me, it's not just what's happening today. It's what's been happening this week, because it was down big, and then it did a U-turn, then it was up small, now it's down big again. I'm looking at the S&P 63 points down, about 500 Dow points to put it into context. Across the board, somewhere between 1.5% to 2.2%. Nikkei's off 2.7%. So it's across the board is the first thing. And very often these big one-day moves are just big one-day moves. But inevitably, this is when the phone starts to ring and people start saying, what should I do? What should I do? What should I do? I even had a coffee bar. I found a new coffee barrister, a coffee barrow in the Liverpool city centre. Wonderful coffee, smoother than a cashmere codpiece, I might add. And randomly, he just said, what do you think? What do you think about the markets? It was on his mind. He was talking about specifically about cryptocurrency. But just when people who don't normally talk about such things, then that's probably not the time to panic. And I always take the weather vane of the narrative of the conversation that's going on around me. We've talked about this as sentiment. So I think now's not the time to panic for the moment. This is something we've been talking about for a few weeks. It's quite possibly a knee-jerk reaction. Sean might talk about it as being a pressure valve from time to time. And it's not really doing anything out of context. And with most of these moves, even though this is a larger move than what we've seen in the last 3 or 4 months on the indexes, But at the same time, it's in context with, well, it's still ultimately going up and has been over the last several months, been going up. But we were worried about this last week as well on the podcast and talking about, you can't have the market go up for 9 straight days without at least seeing some sort of corrective movement. And cyclically, we've got the summer rally coming along. So again, I just can't look at this as anything other than a painful but just profit-taking sell-off. I'm still looking exactly at lines in the sand. I'm always, as my favorite, one of my favorite quotes is W.D. Gann, paraphrasing, but always be prepared to change your mind. And we talk about this as lines in the sand. If it went below, certainly the S&P, if it went below 4,200 on the futures, I'd be reconsidering, because you've got that lovely rising channel which you're marking off there on the over-the-shoulder look. And if it goes below the lower boundary there, it's going to be popping through the 50-period moving average, coincidentally at the same location as that rising trend line. That would be my line in the sand. We can't look at one red day as a market crash or a market sell-off. I just find it funny that we were talking about buying the dip on the official installment of the podcast, and one red day doesn't make a crash, one red day doesn't make a dip. This isn't at buyable location for me. It's got to have 2 or 3 days selling off for me to get really interested to say, this is kind of in that dip territory that we were describing on yesterday's podcast and in the last several weeks. So I always find it interesting that just the speed of movements, the sharpness of the movements, and it's obviously happening before the markets are opening, because we can see this on the pre-market and the overnight futures. It's going to slap a few people in the face, and they're going to panic like most people, and you're not making any sort of sensible, rational decision when you're panicking about what to do. The thing that keeps me sane is, well, what's the strategy saying? Well, it's not saying to sell. It's not saying to manage. It's not saying to buy. It's not saying to do anything for that matter. And from a portfolio,
very important. Sorry, I was going to say very important. Go ahead.
Yeah, go on after you.
I was going to say, we always say, and we actually did a show on this a couple of weeks ago, is that the indexes are not the markets. The indexes are not the markets. And while this can give you a pulse of a collection and basket of stocks, it really isn't the markets. You could look at Apple. It's already up pre-market 1.8%. It's
about 12% index. So how can you measure it?
Exactly.
So just protecting against these things, one of the things that we talk about, it's not the individual trades. It's not the fact that we're buying the dip or selling the rally. To be fair, we're only buying the dip at the moment. I've got a long-only portfolio, but I'm not concerned in the slightest by this type of sell-off. I've got circuit breakers in place. I've got protection. I've got short, in a bizarre twist, I've got short exposure with the clever and creative ways that we manage our portfolio. So it would actually be beneficial if there was a crash, as it were. That would actually be beneficial for my portfolio. Just because we've got protections in place, you can call it not necessarily diversification, but it's just that we've got the portfolio managed to the point where it doesn't really matter what happens. And that's a wonderful place to be. And this allows us to kind of goof around when there's a 600-point sell-off on the Dow. Neither of us are really concerned, and if it actually went further, it's probably going to be even better than having a long-only portfolio, and that's, I don't know about you, Sean, but I find that very refreshing.
I do. And you know what? It's to my mind is, oh, that's all right. And that being in that position with portfolio management and the way we trade is fine. I'll just highlight a couple of other things, little observations.
It's not quite hedged. I
was hesitant to use that word. I was going to say it's kind of like a hedge, but it's not.
It is hedged, but the way that we've described it in the past, it's with option. It's almost like the inverse to going long stock and short options as a way to cash flow your covered call strategy. It's actually the opposite to that is what we do. We've got long options and short stock, and we use it to lock profits in. or to de-risk a trade that might not be performing favorably. So it actually gives us short exposure in a long-only environment, in a long-only portfolio, so that if something weird and funky happens, actually it wouldn't be a bad thing. And if there was a huge monumental movement and we did see 4200 break, I probably don't have to do anything. I'll be making money on the downside because it's going to be beneficial. So this is what we're on about. It's de-risking was the word I was looking for, Sean, earlier. So it's not quite hedge, but it's de-risked to the point where we've got a favorable situation. And this is what we keep talking about. It's not the individual trades that are the driving force behind the success. It's about the management and the money that we keep, or the money that we protect, or in this case, the de-risking of a long-only exposure. It's of no consequence what happens in the next few hours at the opening bell if everyone panics and shits the bed and quite literally dumps everything on the markets. It's not gonna cause me to take any action because we took care of it last week and the week before.
Absolutely. So a couple of observations, guys, that I'm seeing. First of all, we talk about speedboats, different boats in the canal. This is the Russell 2000, and you can see we've been sideways on the Russell for quite a while now, since February of, one could even argue January of 2021. And you can see right here, and again, this is when you're drawing lines in your sand, so to speak. Flip it over to the line chart, and you can see very clearly where these touch points are with previous moves. And you can also do it visually with the candles as well. You can see very clear cut, look left across the chart. Where's it stopped before? And we're right on that point right now with the Russell. We got a previous low here of 2135. And the fact that it's pausing right there, because it was pausing, you actually, as we were going live, you might have seen there was a little wick forming here. Now, we are pre-market by about 10, 12 minutes, but it's interesting to see that right now it's hesitating right exactly on that mark, which is almost cognitive bias from pre-market trading. Looking on the NASDAQ here real quick, again, all-time highs were reached and breached.
Just playing devil's advocate for our loving and adoring viewer today, because we have got visuals in the Facebook group. Could you zoom in on the chart, Sean? Because it's
absolutely.
I've actually got it on the small screen, as if most people, I'm presuming, will be watching it on mobile. So it's just a little bit difficult to see there.
Fair enough. So yeah, you can see previous highs have been breached. Nice little profit taking, and that's what I see today as is take the profits. Let's take a look at, again, the Russell, just to recap that. If you can see on that, that's basically year to date, okay? And it's crystal bloody clear, range bound, where we are right now, pausing right at 2199, which is kind of, or 2200, which is kind of like a nice psychological round number right now. Boom. To me, this is profit taking. The one that I'm really enthused about.
Just looking at the Russell in context, despite that it's as a percentage one of the ones that's moving hardest and fastest compared to the other indexes, it's still as we keep phrasing it, it's not doing anything new, is it? It's not breaking those range lows, the multi-month lows. So yes, it is painful. And we're not denying there's going to be, blood on the streets essentially, but it's not in context. It's not anything to panic over it. And for the moment, it still looks like there is opportunity to buy things at a discount. So what we might want to do is, certainly what I'll be thinking about later is to go and look at all those kind of mid-cap, small-cap stocks that are in the Russell or associated with the Russell, that is a snapshot of those, that area of the markets, and basically just see what's on my list of stocks, my universe of the wellspring of stocks that we draw from, and see not if there's anything that is selling off, but basically, is there anything that's retracing in an uptrend? It might put some things on our radar. Again, it's not an immediate buy. It's not an immediate, let's get ahead of it, let's buy the dip and all the stuff. Listen to the latest podcast. We did comment on that. It just means that, I'm going to be looking in this area. I'm going to be looking for those opportunities. Is there something for me to do? And it might just be that opportunity to raise my awareness of 4, 5, 6 things that look really interesting because of this sell-off today.
Well, I'm looking at the dirty 30, as we call it, and this is pre-market and everything else, like I've said. Looking at this, if you look at things like NVIDIA, it's down 1.6%, but look at over the last year, boom, it's taken off like a rocket. You look at most of these, they are mostly in ascension. Now, let me just do a look on the bearish side of like the different, again, this is kind of a sneak peek at some of the stuff, but you look at some of the stuff that has been just bullish, it's continuously bullish, even during this little reset here. It's boom, boom, boom. It's continuous ascending and moving and doing stuff. I mean, even going back to our Rebel Trader 400 here, just doing the same thing. I mean, this is a sneak peek of the radar. We don't care what's happening over here because it doesn't freaking matter. We're looking at individual assets. I mean, just looking at
just picking up on that comment, Sean, that is actually an interesting point. It's not that we're stressing it. We're using this to say, you know what, there might be several more opportunities than normal because of the sell-off. So I may have to spend an extra hour at the desk just sifting through what may be available because there's going to be a sudden rush of potential things to do or potential candidates. From the portfolio, we're not really worried. But it's more of, hey, there might be more opportunities than a typical day or even a typical week because of the situation. And is there a situational event that's going on at the moment that might cause us to take advantage of it? So, from your point of view, you like trading those sniper moves, news-driven, elevated volatility type of moves. And this is the type of environment that we're currently seeing at the moment. Is there or are there any extra opportunities that we can take advantage of because of the sharp sell-off and that initial panic that people are going to be having at the opening bell? Because people are going to be waking up now. I guarantee they're having the morning coffee, they're reading the papers, virtually speaking, scrolling the news apps. And, what are they seeing? They're going, oh, my God, what's going on?
Here's my trade for the day, PPG. Looking at this one, again, highlighted on the radar, looking at this, and it is, like Phil said, a little bit of a volatility ahead of earnings, even though it's a down day. But PPG, I have no idea who they are, what they do. I don't care. I look at the charts, it's highlighted. I don't care what's happening over here. I know what's happening with this one. And it's highlighting that it's going to pop. Good. I'll take a trade on that one. I'll go place that one in just a moment. So what's happening over here doesn't really freaking matter to me. What is happening in the broad markets might be indicative of, okay, what's going on, but it's like a slow Leviathan of a move. It's not doing anything here. I mean, look at the VIX. We talked about this last week. You can see in the Rebel Traders group. If you're not in the Rebel Traders group, it's facebook.com/groups/Rebel Traders. But we talked about this last week with something interesting happening right here with the VIX. And kind of looking like there may be a little pressure pop, and sure enough, we've had that pressure pop. But guess what? It hasn't breached the previous, and you can see, you can draw a straight line between all these previous highs. It hasn't breached it. It might tickle it through the day. Who knows? Doesn't matter. We don't know, and really we don't care. But it's an observation that may lead to other variables. But again, it doesn't freaking matter. And this is where I think a lot of people get stuck in panic. Because let's have a look at the news just to kind of highlight.
The difference between, I think we said this last week, or you picked up on the comments, so I'm going to pick up on it again this week, just reading between the lines of your comments. It's the difference between being proactive and reactive. When you've got a strategy, a systematic approach to find, filter, and sort opportunities and place trades according to your strategy, you don't really care about what's going on with the markets to any great degree. I mean, sure, our awareness is a little bit more elevated. We're going to stay close by because, we're human. It's that just in case anything crazy is going on. But the reality is it's nothing to panic about. Whereas most people are looking at the news, the headlines, the media, and they're being reactionary and going, oh my God, what's the situation? Blah, blah, blah. And it's that panic, react. It's a knee-jerk reaction that most people will be having when they look at the news and seeing what the overnight futures, or even if they're not doing that, the opening bell happens in 4 or 5 minutes time, and they're going to be panicking because they're going to look at their P&L statements or their live P&L, and they're going to go, spit the coffee out. What's going on here? And then that's when our phone rings. So we're getting ahead of the curve. We're not answering phone calls because we're doing this live session for a change.
That's interesting. And yeah, it's very true. Looking at like Market Watch, we say, hey, big, and what are they doing? What are they highlighting? Is it year to date? Look at the difference in presentation. And this is really where people get their, arse in a sling. From June 28th to right now, it looks like a big, holy crap, sell-off. But what is this? This is the Dow, okay? But let's look at it in context, because this is bloody important. So the Dow, okay? Boom, this is the futures. That is, let's go year to date, just year to date. Look at that in context. What is it doing? Fuck all out of the normal. There's sell-offs and sell-offs, but if you take it in isolation and put it on an hourly, and so did the last few days, oh my God, look at that! It's a crash. It's a swan dive. Dive, Hawkmen, dive. But in reality, you take a bigger look at what is going on, and this is the hourly. So we go back. When you take it in context of what is, it's fuck all. And this is really why this is why we rail on this shit a lot. It's all in the presentation.
Context. It's context, isn't it?
It is.
Most people, the news, the media, the talking heads, they're looking backwards 4 or 5 hours, 4 or 5 days. They're looking at really small. They're looking at a larger than typical move out of context. And when you put it in context, one of the first things that we teach all our students is to look at 8 to 12 months. And you hear us say it every week on the podcast. Look at 8 to 12 months minimum. If you're looking at intraday charts, look at about 300 bars or candles or whatever your preference is. And make sure you've got enough data to have a contextual evaluation of a move or the move that you're looking at. And it suddenly paints a different picture of, is this anything to worry about? Well, most of the time, probably not. Now, the things that we know, the studies that we've done is market corrections and happen probably once every year. And we're talking about a correction as being 10% in 10 days, a big move in a short space of time. They happen about once a year. Cyclically, they happen February, March, and September, October. So, thinking about the time of the year, right, it's not unrealistic that we can't see a summer sell-off. But let's face it, they don't often happen because seasonally, cyclically, if you look back over the last 100, 150 years, they don't happen at this time of year because there's usually a summer rally. So what I'm expecting more than anything is July, August for there to be an end of summer rally, because historically, cyclically, seasonally, over the last 150, 200 years, that's normally what happens. Now, I'm not saying that we can't see a sell-off, but let's just think logically for a moment. The markets are driven by human nature. So all we're really tracking is human behavior. And, we are creatures of habit. So there's a high likelihood that this is probably a buying opportunity. The sell-off may last for 1, 2, 3, or 4 days. How do we know that? Just look back over the last 12 months. You can see the same patterns in the short term repeating over and over again. When you layer it onto the long-term seasonality and cycles of the markets, probably nothing to worry about. And we can't say for certain. No one can say for certain. So don't, mistake my arrogance and confidence, if you like. But it's the context of what is developing and how the markets are unfolding. So don't phone us. It's nothing to panic about. You heard it here first. We were expecting this for the last 7 to 10 days, some sort of corrective movements. But it's going to be a few days at most, probably one day at the very least. And this may be it. If we think about the sell-off from earlier in the week, it lasted one day and turned around very quickly. This could possibly do the same thing because that's the way the market is behaving. But quick one-day pump and sell-off, a little bit of profit taking, and then it U-turns around very, very quickly. We've seen this happen multiple times in the last 8 to 12 months. So don't panic. Don't worry about it. It's not that time of year for a genuine multi-day, possibly even a multi-week sell-off, that might be that corrective move that we keep talking about. I'm looking at that personally September, October time because of the reasons that we've mentioned many, many times over the years. That would be in context. And for any of our long-term listeners of the podcast, you hear us talk about that time of year. And we usually on the money. Sometimes we're a little bit late with that evaluation, but yeah, around about September, October, Phil's normally got his tinfoil hat on, talking sell-offs as usual. And this is the reason. It's just looking at the cyclical nature of the markets. So don't panic. Nothing to worry about. Nothing to see here. Just look for the opportunities as per your strategy. I think's my final thoughts on this subject, Sean.
I agree with you. And again, looking at a couple of nice little shots here. Yeah, GD, I'm liking LNT. Just even though with all this General Dynamics, which again I've been played a few times on that, and
I think looking for stocks that are showing relative strength compared to the huge weakness in the markets. That would be and that's probably why this one highlighted. It's not seeing a huge pre-market sell-off. I mean, like most things, it's been brought down, it's been held heavy, but something that's maybe up on the day and showing that relative strength in a very, very weak market at the moment, might be a good indication.
Yeah, and I mean, there's a few other ones that I'm going to look through after we're done here, but I'm just looking at the ones that flag up. And
I was passing the time looking at some commodity ETF, Sean. I was actually liking JO, which is the ETF for coffee. Okay. And I was actually liking it for a little bit of a counter trend punt, if I'm going to be honest, which is rare for me.
I like for a quick kick.
I was looking at more for a quick hit, just because we've got a nice consolidation over the last 2 months, and it was potentially breaking down below that short-term range. So if you want to have a look at the futures, it's KC, Kilo Charlie. Just to give you a little bit more data. Kilo Charlie, coffee continuous contracts is what I was looking at. So that's where the research started. I thought I actually quite like that, just because you've got a little bit more data on the futures contracts compared to the ETF.
Mm-hmm. Yeah, looking at this as well. I mean, consistent like pulse drops. But
below 150 looked very interesting for me.
October
and
to now,
below $42 seemed very interesting for me. I think it's not there yet, so. But I was just doing a little bit extra. So what's the solution to all of this nonsense? Just put the next trade on according to your strategy.
Yeah, that's exactly it. That's all I'm doing. Yeah, it doesn't matter. I'll keep an eyeball on this. But even now that we are live in the markets, look at the retracement for already. Look at the, again, pre-market panic, and it's already turning around right now.
Dow's up 150 points, S&P's up 10 points. So yeah, it's like, crash cancelled again. The VIX was above 20, now it's below 20, it's closer to 19.
I'm on delayed data. By the way, I'm using TradingView, but I'm not paying for real-time data for some of these guys because I've got that on my TradeStation. So this is delayed data. So where he's saying below 20 and it's not showing that mine, that's because this is on delayed.
Yeah, I'm looking at my live feed here. Yeah. So it's it's almost like panic over, which is literally just what we're saying. I mean, can the markets continue to sell off? Of course they can. We're not saying that this is it, this is over. But follow your process, follow your strategy, apply your money management tactics and routine, and there's most of the time, if you're worried about the sell off, doing something after it's sold off, that's not the time to be having any type of reactionary reactions. What's the right word? You want to overreact. That's the phrase I was looking for.
I was wondering what the fuck is he going with there. That's funny. But I'm just looking at a couple that we talked about in the podcast yesterday. They're off today, a couple of them. So that's it's not breaching turnaround territory. But yeah, interesting stuff. Got to look at HIG real quick. Let's have a look at HIG because that's the one we keep taking the piss out of. Still going sideways, still doing nothing.
Just do something, anything.
It's just there to fuck with us. The markets are fucking with us on both sides. So anyway, with that being said, I think that's a good point to stick a pin in it and say, yeah, don't panic, don't worry. It's interesting to evaluate this in real time when other people are screaming, they're saying, oh, jobless claims are up and Dow drops. Look at the dynamic headline. Dow drops nearly 500 points. But hey, let's do the quick dynamic 350 points. Let's adjust that number so that it's not really a concern. Where's the attention? Jobs rise, unexpected jobless claims rise 373. That's a concern, but that's a broad, small influence
I
over
always
time.
laugh about these types of reports and numbers because if they don't like the number or they don't like the way the market reacted, give it 15 minutes, they'll revise that number. Like, you didn't know the number 15 minutes ago. Like, how can you revise that? Oh, well, we'll miscount it in 15 minutes because they'll update certain reports about 15 minutes later, usually non-farms and we'll revise that.
Yeah, look, there it goes. It's now changed 350, so it's a different picture now, like it's a new story. It's a different picture than and it's funny if you watch like some of these sites, they have different levels of panic in the stock photos that they use. So if it's 600 points, it's like oh my god. Then if it's 350, it's slightly concerned. And then if it's like up, they're all like yay cheer, and it's just like oh come on, for fuck's sake, just
slight concern. Panic on the streets.
Oh, it's up 600 points. Oh, diamond hands, baby. Dear me.
So, yes, it's painful, I think, to sit through these types of sell-offs. Don't overreact. If your strategy says to take action, then take action accordingly. But don't knee-jerk react and respond, because what most people end up doing is closing positions out at the bottom of moves or the top of moves. And you don't want to be the bag holder or what's the opposite to the bag? You don't want to be left carrying the can when the music stops, either at the top of a move or the bottom of a movement. So just follow your process sensibly, make a rational decision. One of the things that I used to do, Sean, was when something weird was happening, I used to go and put the kettle on and make a brew and have a cuppa, just so that I could put an intentional delay with, like, am I just reacting or I'm making up an appropriate response? So that might be something that, all our loving and adoring listeners can do, is when you feel like you want to spontaneously knee-jerk react to a situation that's going on, go and have a cup of tea, go and have a cigarette break, whatever the thing is. It's just going to put a 5-minute block in the way and just collectively think about, is this the right thing to do? And if it's still the right thing to do in 5 minutes, 5 minutes is not going to make much difference to the overall big picture.
Absolutely. Agree 100%. All right. With that being said, rock the hell on. We'll see you next time. Take care. Trade on. All right. Adios.
Always practice safe trading. Remember that.
Absolutely. Must wear protection. All right. Take care.